We heard from Jamie Dimon after the First Republic that he thought pretty much we were over. Maybe there'd be a small lender left. Looks like we're not over this, whatever it is right at this point. How did we get here? Why does this keep going on?
Look, David, I think that we actually are probably over the vast majority of the banking traumas. But look, we still have institutions that have looked vulnerable for some time, and those are the ones that are most affected today. We still have concerns about commercial real estate and what that's going to mean for the creditworthiness of a number of institutions. The circumstances surrounding First Republic with the big deposit from the big banks and with the role J.P. Morgan was playing are in some ways unique. So there are still questions that are going to be around. But I think we should keep some perspective on this, and people should recognize that there's every reason to expect that deposits in the banking system will be money good. I do think that the government has shown that when institutions are mismanaged and blow through all their capital, that their shareholders are going to get out with nothing. And, you know, that is the right thing, and it's probably exerted some bit of negative impact and raised the perceived riskiness of being an equity investor in some of these banks. But I'm concerned today, but I have to say I'm not highly alarmed by what's happening in the banking sector. I'm frankly more alarmed about what's happening in the political sector, where it's clear that we've only got a certain amount of time, and something's got to come together, or something very serious is going to happen.
So I want to come back to that. There's a very important point with Janet Yellen, the Treasury Secretary, saying yesterday, maybe June 1, actually, is the ex-date. But before that, is it a matter of mismanagement? Because clearly some people are saying there has been mismanagement, no doubt. But is there a more systemic effect here? Because we have a lot of banks, it appears. I've seen some reports, maybe half of the U.S. banks actually have liabilities greater than their assets at this point because of the reduced value of the assets, because of the rapid increase in the interest rates. Is there a larger issue of solvency with respect to a lot of U.S. banks at this point?
Look, I think we are going to need to do some very careful thinking about marking bank assets to market and assessing the value of assets in more real ways. But I think there is some alarmism in the calculations you're describing, because it insufficiently recognizes that, yes, if you hold a bond or you hold a mortgage and the interest rate goes up, the value of that mortgage goes down. But equally, if you're having a deposit and that deposit is at a low interest rate, and so you're going to be able to earn a spread, there's an asset there. And when interest rates go up, the value of that asset goes up. And so I think it's kind of alarmist and wrong to focus on the first adjustment and not pay attention to the second adjustment. So yes, absolutely, we have not been as careful in thinking about interest rate increases as we should have been. I think it was kind of amazing and very unfortunate that Fed stress testing didn't put weight on interest rate increase scenarios in the way that it should have, and that's an important intellectual failure by the Federal Reserve System. But I also think that the kind of analyses that you're citing are probably overly alarmist with respect to the risks that are in the system.